Welcome to the Second Bite podcast, where we talk with top entrepreneurs and CEOs about creating valuable companies through creative transactions. Now, let's get started with the show.
All right, welcome back to the Second Bite podcast. Tremendous guest today in the Going It Alone series. Kevin Lee from Didit is with me. Kevin, so happy you're here.
Thanks, Todd. A pleasure to be here.
Yeah, I am really looking forward to this. I got a couple different topics that I want to get into with you. If we can, start with just a quick introduction of Didit, who you serve, and what you do for them.
Sure. So our two biggest industry categories are e-commerce and B2B. That just sort of evolved over the years. We've got clients in a bunch of other tangential categories, including financial services and some travel, some real estate, but and even a fairly large construction company. So we've got clients in a lot of different categories. What we do for them has evolved a lot in the 26 years. So we actually didn't start as an agency. We started as an SEO technology company, and then evolved into a PPC bid management platform, but became an agency just over the years. And there's a backstory for that, which I'm happy to share. But as far as what we do now, we do a lot of paid search management, a lot of paid social management, a lot of other paid media, including even offline media. We've got a media buyer that focuses exclusively on offline media buying, including TV, outdoor advertising, that kind of stuff as well. And we've even got a direct mail division, a few folks who work in a direct mail division because it's gotten completely digitized at this point.
Do you consider yourself a more of a digital marketing agency or a performance agency?
I would say digital performance, right? The performance absolutely is in there because probably 80 to 90% of the budgets we manage are managed against what people would be considered direct response KPIs, right? The clients we've got want sales. Now, our earned media division, which includes SEO, PR, digital PR, content marketing, and earned media social, it's harder to ascribe an ROI to that, in the same way that you can on all the paid media. But at the same time, everything there is created with the direct focus on generating sales.
Got it. And then for rough context, you guys are about 60 to 70 employees and somewhere around 10 million of net revenue. Is that about right?
Yeah, about 10 million in revenue. And we actually target our EBITDA lower than we could because we're constantly reinvesting in growth. And that's been a fairly recent phenomenon that we came up with, that sort of strategy of sort of, reinvesting in growth.
Got it. And then I know you've got the Giving Forward platform. I'm going to hold on that until a little bit later. There's a couple of things that I want to dig into first. So you've been in, I'm going to call it digital marketing for 25 years. And we haven't had digital marketing for 25 years. So I don't know what you started with Didit 25 years ago, but today's business has got to be completely different from that, which tells me you've pivoted a couple of times.
Yeah, more like a dozen times.
and so I'm curious, do you think about, hey, here's what's coming next? Or do you just listen to your customers and see where they're leading you and ask yourself, how do I get better leads, more effective, lower cost for my customers? Can you elaborate on all that?
It's actually sort of both, trying to be ahead of the customer while listening to the customer as well, right? And just to give you the Reader's Digest of the evolution, we started out as an SEO technology company pre-Google, and then we built one of the first bid alert systems for GoTo.com, which ended up going public as Overture, and was the first PPC pay-per-click search marketplace. And they wanted to be their own search engine back when they were GoTo.com. Overture ended up powering other folks. And then that was before Google had their paid ads platform. So then Google launched AdWords. We automated into that. And that business was actually fantastic for a bunch of years. And then a company called Marin Software raised $101 million in venture capital with the objective to go public, which they did. They went public, I believe, at about $420 million valuation. The challenge was that they were really aggressive in pricing, and they've never even had a profitable quarter, to my knowledge. So
if you don't have to be profitable, it takes the edge off, right? From that standpoint.
Well, you can imagine what happened to their stock price in the intervening dozen years or so. But the problem is if you're a privately held company and you're in the SaaS business and you're competing with a public company who seems to be okay or unable to sort of figure out how to make a profit or get their prices up to the point where everybody in the industry can make a profit, it makes that a non-tenable business. So we layered services on top of our tech initially to say, hey, our software is not that hard to use, but why don't we use it for you? We know how to drive the race car better than you. You might crash it, or you might just not be able to drive it fast enough. So we, layered pay-per-click search management services on top of our software. And then over time, people kept asking us to do more things for them because they wanted to manage budgets holistically. They didn't want to have a search marketing budget and a display media budget and a video marketing budget. They wanted everything centralized. And so we decided to make an acquisition because we had a catch-22, because I couldn't sell them the new thing if I didn't have the people to do it. And they didn't want to hire the people to do it if I didn't have a customer ready, right? So we just happened into a company called Inceptor out of Boston, which had previously been sold to Verizon Information Systems, which had then decided to change their name to Supermedia, and they decided they didn't want the agency like 8 years after they acquired it. And so we ended up getting the agency and its clients and its staff. So the staffing part, obviously we were buying the revenue and we were buying the clients, but the really important part for us was there were folks there who were subject matter experts in areas that we didn't have the subject matter expertise. That allowed us to cross-sell, right? And then as we started to do other acquisitions, for example, in the PR category.
So if I can slow you down, Kevin, can I click on that? So now we're talking about your very first acquisition.
Yeah.
Right. You've never done an acquisition before. You don't know how they work. You don't have experience. Can you take us back to that time and describe any kind of memories that come back to you, or why you thought you could pull it off, and what the biggest challenges to getting that done were?
It was almost exclusively luck, right? Because this agency had been purchased previously. It was now, owned by Supermedia. They decided they didn't want the agency anymore.
They
the
just wanted to
agency
get rid of it.
was losing a little bit of money. Not a tremendous amount, but it was losing some money. And as a result, obviously, the financial indicators, right, were such that it might be a reasonably good deal. And we had our own technology at the time. They were forced to use somebody else's technology. They were using a technology called Kenshu, which has since renamed itself. But we could immediately add additional efficiency because we were replacing an external technology with an internal technology. I think actually, no, maybe they weren't using Kenshu. They were using Search Ignite, which had renamed itself Ignition One. But in any case, we were able to sort of replace the technology. But we had a conversation, and we looked at the numbers, and there was a lot of revenue concentration risk with a couple of big clients. And so normally you would factor that revenue concentration risk into the deal structure. And if you were buying something from an individual, you would typically structure it with an upfront number and then an earnout. But because this was a public company, they're like, no, we just want a number, right? So it was a very different kind of a deal structure than the ones we did subsequently. But again, this was my first one. So we looked at the numbers and we said, oh, well, revenue concentration risk, a reasonable out clause on the contract, like that could go away a month after we acquire it, right? So we really can't go too crazy. The number we came up with, we presented a LOI, letter of intent, and the investment banker said, like, oh no, we're going to get better offers better than that. And I said, congratulations. So, take those offers. So they went off, and 2 months later they came back and they said, oh, that other offer that we thought we were going to get, it fell through. There was an issue with the board. The president of the company thought he had the authority to do a deal of that size, but he didn't. Then the board got cold feet, probably due to the concentration risk, and then decided they didn't want it at all. And, they said to us, do you still want it? And I said, yeah, we're still interested in it, but we need to do more deeper due diligence, because we had given an LOI just based on surface level due diligence. Because and we dug deeper. And then we found more issues.
So how did you know where to dig? As an agency owner, is it like the standard stuff? I want to understand what the contracts are. I want to understand who's servicing this, or are there other things you were looking for?
It was primarily that, right? It was primarily us trying to get a sense as to how sticky were the clients, how happy were the clients, how happy were the staff, and how engaged were they, because they were working for a big company now for a while. And but what was interesting is, based on our second level of layer of due diligence, we said we can't do the number in the LOI, and that was the number that they had said was way too low the first
Right.
time.
Yeah.
And we said, no, we actually have to discount off of that because we bullet pointed the issues. And they said, oh, well, we can't do a deal that way. I'm like, that's okay, but that's just what we would need to do to get the deal done. And that was myself and my founding business partner and the angel investor that had funded defending us in a frivolous lawsuit previously. So he was the sort of capital side of the equation. And so, they said, oh, no, that's too low of a number. And we didn't hear from them for like a week and a half. And then they came back to us and they said, how quickly could you get a deal done if we could come to an agreement with the lawyers? And I said, well, if the lawyers agreed tomorrow, we could get the deal done tomorrow, but I don't think that's going to happen. But we could get the deal done pretty quickly. And they said, all right, let's get the lawyers in contact. And then the deal ended up happening. So the revenue concentration risk was one particular large client. It ended up that they stayed a long time because the team was great. And then our technology was superior to the technology that was being used previously. At least we felt that way.
That helped, right? Of course.
Or maybe it was just that we built it so we knew how to use it really well. And so it ended up being the best acquisition we did. It was the first one.
And so, and now it's what you described, sometimes people call that retrading. And I want to bring this up because retrading has this negative context to it, right? You made them an offer, forget the 2 months for a minute. You made them an offer and then you retraded with a lower price. And the reality is sometimes when you do due diligence, things come up that make you nervous. Things come up that shift the value of the business in the eyes of the buyer, right? So for our clients, we make sure that because you can't ever hide anything in diligence. There's too many smart people looking at your business. They're going to find it all out. And then the deal's going to shift. So we always believe it's much better to get all that stuff out, sell into that weakness, and make sure that all of your buyers know. So you're not 30, 60 days into due diligence and then things change. Do you remember what that second layer of concern, what that was focused around?
It was really just the level of revenue concentration risk and the out clauses in the contracts, right?
That you didn't know until you actually got to that level.
Right. We didn't have a copy of the contract in the preliminaries. We were just given financials, right?
Sure.
So we didn't have copies of the contract.
Yeah. And in the context of a deal, oftentimes you can't say, listen, we're going to give you an LOI, but we need to see all your contracts. Because nobody's going to give their contracts to somebody that hasn't even signed an LOI yet, right?
Yeah.
This is part of doing transactions.
And there are situations. I'm in the middle of, transacting now, oddly enough, to buy a brand. And this is really just me personally because I'm more of a marketing mad scientist. I'm really not an agency guy. I mean, yes, I worked at J. Walter Thompson and McCann Erickson before starting the predecessor to Didit, and then Didit evolved into an agency. But I'm really more of a tech nerd and a marketing mad scientist, which means I need a full lab. And having just the agency side of the lab and the ability to build technologies for clients is one thing, but implementing it when it's still rickety and asking a client to take the risk is not something that is easy to do. So I'm going to be buying a small nutraceutical brand. The reason I bring that up is we discovered something in the later stage of due diligence, and rather than lower the price, we reframed it and we said, listen, we have to mitigate this risk. So I don't want the price to change, but we need to hold out a certain amount of money in escrow just in case this unlikely thing actually happens, right? It's unlikely, but we need to sort of carve it out, put it in escrow, and have that particular thing not pay out for 2 years. Because after 2 years, I'm willing to take the risk. So it wasn't a matter of, sometimes there are more innovative ways to sort of address that. Now, and as far as your point about smart people and due diligence, there was a situation with one of our acquisitions where we missed something in due diligence that in hindsight we should have caught, but it resulted in a huge implosion and litigation and everything. And that's not fun for anybody.
Not fun for anybody. You know, and just for the folks listening, escrow is a very helpful tool. So you've identified an issue. I'm going to make up numbers. That issue, if it happens, could cost us $250,000. So we're not going to lower the price by $250,000 because we don't know if this will ever happen or not. And we're certainly not going to come chase you for $250,000 a year from now. So what we will do is take $250,000, which is real money, right? There's an escrow account somewhere that has your 250 in it, that if that issue doesn't happen, is going to go to them. And if it does happen, it's going to come to us.
Right. Exactly.
And so that can be a super creative tool. I'm glad that you brought that up. Let me ask, in the very first acquisition, do you remember how many people came with that deal?
Initially, I think it was 17 or 18, some of whom were redundant to us, right?
Yeah.
Because we had a direct overlap. So there was a very small reduction in force.
So I'll tell you what makes me nervous for a guy like you. And when I say a guy like you, I mean the mad scientist. Is somebody's got to be there watching the business, right? Somebody's got to be there. We've got 17 new bodies here that need to be told what to do and how we work. And how did you manage it, and how do you manage it now?
Well, at the time, my co-founding business partner was very operations focused. And so, he and another group of fairly senior executives were really great at that stuff, right? Over time, he recently retired just about a year ago. And we took our SVP of client services, who's not only great with people internally and externally, but also really great with numbers. So between him and the controller and HR, I'm really important to the business, particularly from a biz dev and strategy perspective. But the reality is that if I took an extended vacation of 3 months, I could come back and pretty much be guaranteed that things didn't break, right? I mean, there are things that break in general, but I would feel confident in the ability for the team to run the business.
Because of Eric, your CEO.
Yeah.
Now, let me ask this, because that sounds wonderful. And I've got a bunch of guys and women, CEOs, that love that idea, have tried to hire a COO or a CEO type, and it's almost always been a disaster. And maybe sometimes they won't let go of the reins. Maybe sometimes the other guy's not right, whatever the case may be. Eric's been with you for a long time. He's also been the CEO now for a year plus. Is there any advice you would give to somebody in terms of A, identifying the skill set, and B, what to do when you make somebody your COO or CEO that you think would be helpful?
Yeah, I mean, we also tried an external CEO hire, right? Probably 15 years back, to sort of bring in a professional CEO, and great guy and super talented. It just ended up that at the time, my co-founding business partner and I, and perhaps more him than me, were still quite autocratic.
And were you bringing him in because you wanted to accelerate the growth, or because you wanted to spend more time in the lab doing crazy stuff?
Accelerate growth.
Okay.
And again, hindsight is 2020. He ended up being super successful and is the CEO of a major company at the moment. But it was sort of a learning experience, I think, for both sides, right? With regards
and the issue there was that you wouldn't let go of the reins enough, or if you were going to be critical of that, what would you say?
I think it was probably some things which should have been set out expectation-wise earlier on, hadn't been, with regards to sort of the vision of that growth path.
What's an example?
So, moving into new categories, including sort of building more speculative technologies or engaging in sort of media arbitrage, right? One of our competitors that sold early spun up a media division, and it juiced up their revenues dramatically, and ended up having a great exit. But I wasn't, we weren't sure, like, could we do exactly that, or whether there would be another buyer willing to sort of overpay based on a subsidiary division that was like just juicing up the numbers as opposed to the core division. And so there was that, and there were some other sort of product roadmap related issues, and some strategic issues that really sort of hadn't been discussed in sufficient detail initially. my retired business partner has a big personality, and I think part of that dynamic perhaps exacerbated the situation. I think if we had been able to sort of sit down and work through the things, it may have worked out differently. So we also sort of, I guess, jointly failed, because we take a lot of the responsibility for the failure, but there might be some responsibility for the counterparty. But we also sort of failed at the hiring of the professional CEO. Eric grew up through the ranks of the company, right? And I think that you don't have an issue with regards to corporate culture when the person's been with you since they were an account manager,
right?
They've been there through the thick and the thin, and they know the dynamics, the personalities, the areas of focus, et cetera. And that has been obviously a much smoother transition, right? Just because it was really just a roles and responsibilities shift, right, as opposed to anything more dramatic than that. I think obviously, if Eric were on the call, he'd probably say he didn't realize how much extra work it was going to be, and the sort of additional weight on his shoulders. But he was really perfectly positioned to take on the role.
And so that's super helpful. Thanks for that insight. So as you now move forward, you've done a total of 11 acquisitions / acqui-hires. And you mentioned an angel investor. Have you brought in outside money to help you complete some of those transactions?
Not for any of the M&A. The angel investor has been there in an advisory capacity, and could be available, for capital if we had needed capital. But we ended up not really needing the capital. We had sufficient cash on the books to do the deals that we've done, right? And by structuring them appropriately with the right amount of upfront money and the right amount of earnout, and then in some cases tying earnouts to specific milestones and achievable targets, we felt like we had mitigated sufficient risk to do those deals.
And so with the experience of these deals, and particularly smaller end deals, is there one or two nuggets in there that are valuable lessons learned that on deal number 12 you will make sure this and this are part of that transaction?
Yeah, I think that, again, this may have had to do to some extent with the sort of strong personality of my operating business partner, pre-Eric. But you need to remember that these people that you're acquiring, that the owner or owners, right, if there's more than one, they built a viable business, right? And I think we didn't, I don't want to point fingers, but I don't think we engaged them to the level that we could have, right? Because some of them wanted to remain more engaged in the business and continuing to grow it, and others perhaps didn't, right? Others were really just interested in putting in their couple of additional years and then retiring. And I think, again, having the upfront conversation about to what extent they want to remain active, and in which roles and how their roles might change as they essentially become an employee again, which is very difficult for some of them, right? Which I don't blame them at all. But after being on your own for a long time, sometimes 15, 20 years, right, to suddenly become an employee and sort of have to ask permission for something that you hadn't had to ask permission for in 15 or 20 years. I think that's a shock to anybody. I don't know if I could do it. Right. I mean, it would be, I would really need to sort of stop, take a deep breath, and, figure it out. So, I think you need to, everyone sort of needs to understand what the expectations are. And I think we probably missed opportunities as a result, post closings, in tapping into the wisdom of some of the folks, when we did the acquisitions. And were we to do another one, like if another opportunity were to pop up now, I would want to have like a big piece of the due diligence would not be, digging into the history, but really understanding more about that person's interests and desires for the future.
Yeah. And that's a great transition point. So, you've been at this for a long time. You're doing $1 million+ of EBITDA. You've got a great business, great reputation in the space, on and on from that standpoint. I'm sure you get knocks at the door all the time that say, Kevin, why don't we do this? Why don't we acquire you? Why don't you become part of us? Why don't you partner with private equity? How do you think about the next 10 years of the business and what you see for Didit and for yourself?
Yeah, I mean, in the last year, now that Eric and I are sort of running the show, we've had a chance to sort of refocus our strategy and sort of pick specific categories and preferred geographies as opposed to which to some extent is different than the previous strategy. And I think there was some tension previously as a result of some differences in strategy. So now I think we're much more unified on the strategy. So I'd like to probably triple the size of the agency before I think. I mean, I'm not young. I'll be 58 in a couple of weeks, right? I'm not itching to exit. Part of the reason that when folks would sniff around that I didn't really take it too seriously. Well, there are a variety of reasons, but part of it was really just that I'm still having fun every day as a marketing mad scientist, right? So I'm inventing stuff for us. I'm inventing stuff for clients. That's really fun. I mean, I've invented stuff in the direct mail business, which I think is just, who wants to invent something in like one of the oldest channels, right? Like, well, but I it's fun to take the look at the problems that folks are facing and solve them, right? And sometimes you just solve them with good old fashioned agency strategy, and sometimes when technology layers in, it's more fun for me.
Yeah.
So I don't see myself retiring. I mean, I have a nonprofit that could take up all of my time if I wanted it to, right? But I'm just not like a retirement mindset person. So even if I were to be acquired, I'd probably hang around for quite some time,
Sure.
especially if I were given an opportunity to continue to invent.
Yeah, and I think if there were private equity guys listening to this, they would say, geez, if this guy really wants to triple the business, and if he's obviously capable of doing that, we would help with the investment and the diligence and the sourcing of those opportunities to accelerate the growth and to turn this into something, bigger and larger. Your biggest hesitation around that, is it just what your life would be like? Because I would assume post-close, you would still own 20 or 30 something percent of the company. Is your concern just your ability to be a mad scientist, your ability to invest where you want to, your ability to, what do you think holds you back from that perspective?
That's a big part of it. But I think that I probably want to at least be double the size before I entertained a PE style transaction. And obviously, there's always an offer that you can't refuse, right? But just numerically, right, given the cap table and how the cap table is structured, for me, it wouldn't really make sense unless we were at double the size, at which point, if somebody wanted to sort of use us as the foundation for a roll-up, if the visions of the folks, underwriting that and mine aligned, I'm not averse to sort of being the platform on which things are built.
Sure.
And having done a bunch of acquisitions, I've sort of seen the good, the bad, and the ugly. So one thing, the difference between when you're doing, acquisitions funded by PE versus funded yourself, right, is obviously you're taking it out of cash. That has significant implications, particularly in a pass-through organization, right, where you accumulate the cash. You still owe the feds the tax on it.
Right.
Now you're going to go use it to make an acquisition. There are tax implications to that. Whereas, almost the exact opposite situation in the PE funded acquisition, in that they're using leverage. They used leverage. They used some of their own money, and then they're using leverage on top of that. They borrow a bunch of money to fund their acquisition of typically, 55 to 60% or to 55 to 70% of the company. And then they'll leave if they want to keep management in there to really help execute, obviously they make it worth your while, right?
Sure.
And there's all sorts of ways you could earn back in, ways to use warrants and options and things like that. But for me, I would say until I can double the size of the company, that would be a distraction, right?
And I will say, and I appreciate you sharing that, because there's many ways to grow a business and to be in a business. And the reason we have the Go It Alone series is just to show that people can do acquisition, can grow their business, can create a strong, consistently performing company and grow that, perhaps double or triple over the next few years without using private equity money. So I appreciate your time with us today. I appreciate your perspective on the future of how you want to grow the business and how you've gotten to here. It's always great to hear it directly from somebody that's been as successful at it as you have. It'll be great to watch, the growth of Didit over time, and hopefully we'll both still be around in a handful of years, and we can look back on this and compare it to where you are in 4 or 5 years from now. So, Kevin Lee from Didit, thank you so much. This was a great episode of the Second Bite podcast, and we're super happy to have had you join us.
Thanks, Todd.
Thanks for listening to the Second Bite podcast. We'll see you again next time, and be sure to click subscribe to get future episodes.